Awesome. Hey, can everyone hear me? Andrew, is that Ray?
Yes.
Hi, Ray.
Hi, Benson.
Good to see you. Okay, so a little bit about me. I am a mortgage broker, and mostly do commercial. Man, wow, I already screwed up. Mostly do conventional loan. I don't know where my head was. Mostly do conventional loan. A lot of times we do conventional VA, FHA. Um, Hi, Brian. Hi, Roy. And I've been doing mortgage brokerage for about 10 years. So this will be my 10-year mark. And before this, I actually was a civil engineer before. I studied civil engineer. Um, my mom is she immigrated here and she brought me here. I came here when I was 14, went to high school here in Arcadia High, and when I was trying to look for what to major in, my mom's like, "You got to major in some engineering stuff," because math was the only thing I was good at. um, so when I say good, it's like B, not even A. So I went to school for civil engineering, got my degree. I worked at a nuclear power plant for 4 years, got my PE, got out of engineering and started helping my mom to process loans. So I've been in the industry for 10 years. A couple years ago, I started my own company and pulled a couple people out, the three of us, and then now we grew to a team of 22. So a little bit about me. If you
You're
Google,
not glowing green.
hmm?
How come you're not glowing green?
What? So it's only when at night though. At night I do.
Ah, I see.
Yeah, when the moon is out, yeah, that's when I glow green. So you never
Nice.
lose me in the ocean at night. um, so thank you. So a couple years ago, started a team, and like I said, we mostly did conventional loan, and we started doing some non-conventional loan, and I'll tell you guys all about it later. Uh, 2 years ago, I started looking into it, and then we really put it in practice in the last 12 months, and it's been getting some pretty good results. We've been working with a lot of real estate investors, especially some out of state, where they can get um, equity is right now is at all-time high, so they're able to get their equity back out and reinvest that money. So we've been using that strategy to help investor to double down on the real estate, be it in
Cool.
California or outside. Yeah.
All right, cool. So, well, again, like I said earlier, thank you for doing this for us. So we have some people who are, on this call who's like spanking new into the business, right? Know nothing about loans. They're just really getting their feet wet right now with, the ins and outs of real estate, like how to work with clients, whether it's like the buyer, seller, a tenant, a landlord, like whatever, right? So I really wanted to do this call because I want them to hear it from like the horse's mouth, right? So just kind of like your lending basics. I know that, we don't expect um, agents to know the ins and outs of what happens in a loan, but I think just enough where they can sound knowledgeable enough and know enough about the basics of the loan to be able to help their clients when they're doing their initial consultation, right? Whether it's they're representing the buyer or representing the seller. So, you brought up some really great terms just now when you were doing your intro. So, kind of let's talk a little bit about that, right? So, I hear a lot about, oh, it's a conventional, non-QM, non-conventional, jumbo, high balance, and all these jargon that's used in the lending world. Can you kind of give us a really brief explanation as to what each of those terms mean?
Yeah, absolutely. I think we talked about conventional, non-conventional, high balance, and conforming loan. Um, it's like it took me a few years to really learn about it too. It's not just all like it didn't all click. So if it's not clicking today, it's not you. It's just the industry. It's the game, right? But to start, you got to understand what is a conventional loan. Okay, a conventional loan is basically a loan that very conventional. Like everyone gets it, or most of the people will probably get a conventional loan. Um, and a conventional loan is has a set of guidelines that we lenders have to follow, and most of the time we review credit, income, and assets, and the collateral, which is the house itself that they're buying or refinancing. And a
Oh,
conventional loan means
no, go ahead. Go ahead.
means that once it's a loan that is sold to the two government sponsor and enterprise, which is Fannie Mae and Freddie Mac. Okay. So Fannie Mae and Freddie Mac basically are two agencies where they buy up all these mortgages, and then they sell it to the secondary market. So like Karen's getting a loan, you're getting Brian's getting a loan, Ray's getting a loan, and then what Fannie Mae doesn't just have unlimited amount of money give the client, give the borrower, right? What they end up doing is they put it in a bundle in a tape, and then they sell it to, let's say, wherever your let's say your like a teacher's foundation, right? They might have a pension that they invest in some sort of real estate collateral trust fund type of deal, and they would invest in that tape. They buy it out, and that then they get paid a certain amount of percentage per year. So they sell it off to a secondary market as an investment for other people. That's how they get their money back. Then they can continue to buy more tapes. No.
So, Benson, you mentioned earlier that as lenders, you guys have guidelines that you need to follow, right? So, who's the one that determines these guidelines and makes them up?
So Fannie and Freddie, because they have the responsibility, right, to make sure when your mom's pension is investing in a Fannie Mae's loan is going to get paid that monthly payment. Fannie and Freddie needs to make sure that the loan that they're giving out is of quality, to make sure the borrower has the ability to repay that loan. So they set up guidelines and say, hey, you need to make this much money to qualify for this payment. You can't have a bankruptcy 7 years before you apply for this loan. They need to make sure you have at least 620 FICO score. They need to make sure your house is not the roof is falling. You need an appraiser out there to make sure the house is there. So they are the ones that come up with the guidelines. And back in the little history, right, 2004 and 5 and 6, Fannie Mae is just buying up loans. They don't even review what is being what they're loaning on. They say they like some loan officer will go up to them and say, hey, my borrower would like to buy this house for $1 million and borrow $1 million. Back then 100% LTV, loan to value, is available. So then Fannie Mae would just buy it up, and then little did we know that that house is not worth $1 million. Two, the client actually can't pay a $5,000 mortgage payment every month. And then it imploded into a 2008 financial crisis. So after 2008, Fannie Mae's now like, okay, I got to make sure we check all these things. In fact, we call it qualified mortgage, QM. Okay, so you got to, if you fit the box that Fannie Mae and Freddie Mac come up with, it is sponsored by the government, it's backed by the government, and therefore, like, the pension people can go, okay, it's backed by the government, we'll put money in there to buy that tape.
Cool. So that's what conventional loans are.
conventional loans. And then you hear about conforming or conforming high balance. Hang on one second. Okay. Conforming and conforming high balance. So like, let's say conforming loan is basically like, so Karen might be super wealthy, right? She's buying a $3 million house, getting a $2.4 million loan. Okay. $2.4 million loan. And on the other hand, Benson is super poor and he's buying a $300,000 house and putting 10% down, which is, $270,000 loan. So $270,000 loan and $2.4 million loan, right? Like, where should the cutoff be? Okay. Then Fanny and Freddie actually come up with numbers every year. Actually, it's FHFA. I forgot, Federal Housing Financial something Authority. Okay, so basically FHFA comes up with a loan limit every year and say, okay, across the country, $548,250 is going to be the loan limit for 2022. And then they go, okay, but we also recognize there are places with higher value. We'll give it up to 150% of the conforming loan limit and call it conforming high balance. So now in places like OC and LA, you can buy a house that's a little bit higher in value and you don't have to go with a jumbo loan. It can still be sold to Fannie Mae and Freddie Mac. But if you go to IE, Riverside and San Bernardino, it's like you can't because the house prices is not that high. It's not considered as a high cost area. Yes, there are a couple of cities like Chino Hills that, yeah, they have a higher prices, but unfortunately, their loan limit stays with IE. It's per county.
Okay. So, so what you mentioned earlier, like non-QM, what does that mean?
Okay, great question. So there's QM and non-QM, qualified mortgage, selling to Fannie Mae and Freddie Mac. And you think about it, right? You go to school, you get a degree, you get 4.0. B student, you get 3.0, right? So if you're a B student, doesn't mean that you don't get a loan. So think about it. QM is for A students, and everyone else get the non-QM loan. So think of it like, let's say you have a self-employed borrower or buyer in this case. Maybe they own a restaurant. They get really good business in, but because they have a lot of expenses that they write off, maybe even more than what they're supposed to write off, and they have very little net income at the end of the year, they might not qualify for a QM loan. So then we would have to go with a non-QM loan, which is a bank statement loan, to look at their 12 months or 24 months of bank statement, look at all their income, analyze it over 12 months to see what their average monthly income is, and take an expense ratio. Another non-QM loan would be like, let's say if your client is just file a bankruptcy 4 years ago, conforming conventional loan will require 7 years, right? So you would go with a non-QM where they would allow 2 years of coming out of a bankruptcy and they would be able to do that loan.
So, in other words, the difference between a QM, which is a qualified mortgage, or wait, yeah, qualified mortgage, right? And a non-qualified mortgage is whether or not they're able to show their income, in essence.
Yes. It's
Wow.
whether or not they can show their income. It could be a credit event. It could be because they have already 10
Well, let's
properties.
talk a little bit about this. Okay, so you say a credit event, right? And you just mentioned like FICO. What is that?
Okay, so a FICO score, I don't know what the long form is. Basically, it's a credit score that you have that we calculate based on your spending habits with your credit cards, your loan, how often, like how on time you're making your payments, your credit history, and then we calculate it using your data from the 3 credit bureaus. So credit bureaus are the people that they're not government, they're privatized industry or bureaus. I know they're called bureaus. Don't let it fool you. They're private. They sell your information too. Just FYI. Um, where when you spend, let's say you have a credit card, right? Chase, whatever that credit card is. You go buy something, and then at the end of the month, you get a balance from that credit card and the minimum payment. That balance and the minimum payment on the statement gets reported to the 3 credit bureaus. And then for us, when we pull the credit, we don't go call like, hey, Experian, can you send me the credit score? It doesn't work like that. We work with a credit reporting company. The credit reporting company will take information from all 3 credit bureaus, and then they calculate what the credit score is with these data that they collect. And each credit bureau will come up with a score, like the data that's collected, and we take the middle FICO score. So like, let's say if like Karen's getting a loan and Karen's mom's also on the loan, then we take the worst of their middle credit score to be more conservative.
Okay. How does the credit score impact a buyer in getting a loan?
So the credit score can make or break a loan because there's minimum credit score requirement. And then credit score can also determine what interest rate or how many points your client's going to pay for a specific interest rate.
I'm glad that you brought up points. What are points?
Yep. So so points for, like, let's say you hear discount points or points for interest rate is basically like, let's say they already have a certain amount of closing costs, right? You have the lender fees, appraisal fees, escrow fees, title fees, notary fees, sub escrow fees, recording fees, any prepaid taxes and insurance and all that stuff. Because your client wants a lower lower interest rate than like what we were already giving them. Like, let's say we give them a 4% interest rate at 0 point, they want 3.5%. They can elect to pay, let's say, 1% of the loan amount to lower that interest rate, because in their mind it may make sense, right? If they're going to be there for a super long term, they're going to keep that loan for a very long term, they want to get that lower rate, or even to qualify for a loan, they want that very low rate. They can pay points to lower the interest rate. For in the non-QM world, it works a little bit different. The points may go to like a broker, broker compensation. So like people like me in a conventional QM world, we get paid by the lender. In a non-QM world, a lot of times we might get paid by the borrower, which is your buyer. So there are 2 different types of pay, so to speak, for brokers.
Oh, that's interesting. Okay. So, what is my next question? Well, before I ask my next question, when I can think of what I want to ask next, does anybody on the call have any questions in regards to what Benson has covered?
I have a question. Hi, Benson. Thanks for doing this.
Hey, Brian.
How heavy do you weigh assets like a 401k or like a Roth account, or like just like what you have in like a stock brokerage like Robinhood or something?
So I view it as two ways. There are 2 ways of looking at it. The conventional way, which is like very common, is the down payment, right? Are you asking where? So my question is like, are you using your 401k, or where is your asset coming from for the down payment, and also reserves? So down payment, obviously, it's like the difference between your purchase price and the loan amount. the amount that you have to put down. It can come from your 401k, like a loan. You can take a hardship withdrawal, or you can, liquidate stocks to pay for it. And then if it's reserves, we have a calculation of how much your reserves needed. So each person has a different scenario. Usually it's like, let's say, even Fanny and Freddie have different requirements for reserve. So like, let's say Fanny's requiring 2 months of PITI. I'll get to what 2 PITI is. Basically your payment as a reserve. But if you own additional investment property, they might ask for more reserves. So that can actually come from your investment or your 401k account.
Okay.
It's based on a need structure. It's not absolutely required, but it is if your situation does need it.
It sounds to me like the more liquid you are, the better. Is that correct?
No, not. I mean, for the down payment, yes, right. But if I'm using it as a reserve, then I can have $1 million in Apple stocks, and I would
Okay.
use like 60% or 70% of the whole entire portfolio, which is $700,000. That would be enough to satisfy the reserve condition.
Okay, gotcha.
But
Hey,
if you need it
Benson,
for down payment, you would have to liquidate it, take it out. What's up?
Benson, you just mentioned PITI. Can you kind of elaborate a little bit what it stands for and what it means?
Yeah, so PITI you hear a lot in this industry, or PITIA or PITIA. So basically it means one thing: your total monthly payment for buying that house. You wouldn't have that payment if you don't buy the house. PITI means principal, interest, tax, insurance. A stands for association, so HOA. There's also mortgage insurance. If you put less than 20% down, that can be involved in the PITI calculation.
Cool. So I know a lot of people hear about, oh, to do a mortgage, you need to have 20% down. Is that true?
Absolutely not. So again, depends on your situation, right? So let's say you're a first-time home buyer, you you only have 5% down or 3.5% down. We work with a lot of people who do as little as 3% down. Conforming loan, you can go as little as 3. High balance, you can do 5. FHA loan, you can do 3.5. VA loan, you can do 0% down. So there's a lot of low down payment options.
So you just mentioned about FHA and VA loans. What are those?
So basically, an FHA loan is, I like to call it a Band-Aid loan to people who have a flawed credit history. They actually allow 2 years out of a short sale for an FHA loan versus 4 years for conventional loan. And FHA loans basically also backed by the government. In fact, the mortgage insurance that you pay is actually going to a pool that the the Federal Housing Authority created to make sure your mortgage, if your mortgage is default, then the government basically ensures that the investors get payback. Whew.
Who would use FHA?
Yeah, so FHA is usually used by people with a flawed credit. Maybe they have a short sale or a bankruptcy that isn't long enough. It's long enough for an FHA loan, but not long enough for a conventional loan. Or people who have lower credit score. Typically, anyone who is doing 5% down, like less than 20% down with a less than 700 credit score, will start looking into an FHA loan for the client, because then the monthly payment may start making sense. Because remember, your mortgage insurance rate and your interest rate, it depends on your credit score, and if it's lower than 70, that rates start to increase dramatically versus FHA, the interest rate doesn't increase dramatically. The mortgage insurance stay the same. So it really depends on how do we balance the two. A big reason why we don't like to push clients to FHA loans is because there's an upfront mortgage insurance premium, 1.75% of upfront mortgage insurance premium. A lot of times clients don't see it because it's rolled into the loan, it's financed into a loan, so they don't feel like they're paying that 1.75%. So and then a lot of lenders out there, they actually make more money on an FHA loan um, than a conventional loan. So it's much easier for them to just push. Like it makes sense. I make 30K on this loan versus 15 on the other loan. I might as well throw the client into an FHA loan. We make the same amount for same percentage for all the clients.
Oh, that's interesting. So, so what about like VA loans?
VA loans, I'm glad you brought it up. Oh my God. So we work with a lot of VA. So VA doesn't stand for virtual assistant in this case. It stands for veterans. Veterans who served our country, died for our country, or maybe got disabled. So anyone who served our country, and in some cases while serving, they also qualify for a VA loan. And and to show that you qualify, usually we ask for this thing called certificate of eligibility. So the first thing we ask you is, hey client, thanks for serving our country. Can we get the COE, like certificate of eligibility? And on that form, it shows us how much entitlement they can get, and also eliminates the chances that they may not qualify for a VA loan. It actually happened to me once. I didn't ask for the COE until way like while we're in escrow and found out that he's not qualified for a VA loan. So get those information up front if you can. But for VA loans, you get 0% down. You pay an upfront funding fee, which is also rolled into the loan. If you're disabled, any disability, you actually get that funding fee waived, exempt, and there's no monthly mortgage insurance. The most beautiful part is you can go up to 70% DTI, debt to income ratio.
Oh, I actually didn't know that. That's very interesting.
Yeah.
So what is DTI?
See, I'm glad you asked what DTI is, because it's something that we look at all the time. QM, non-QM loans, always DTI except for an investor loan, but that's maybe another day. So DTI, debt to income ratio, meaning your debt divided by your income needs to be at a certain amount of ratio. In this case, let's use 50% in this case. There are cases like your jumbo loans may need 43%. So each loan program is a little different, but for this conversation's sake, 50% is the most common. If they have any flaws on their credit score or they're putting very little down payment, might lower to 45%. So debt divided by income needs to be 50%. So basically you need to make double of how much you're paying. How much are you paying is your PITI plus any of the, remember early on we talked about those minimum payment that gets reported to the credit bureau. So your if you have 5 credit cards and you actually use those credit cards, would be like $35, $25. We add them up, and then maybe your auto leases, monthly payments, we add them up along with your PITI. So you got to make double that amount.
Do student loans count in your debt to income ratio?
Student loans absolutely count in our debt to income ratio because you are going to eventually pay it back. A lot of times, like especially now that it's being deferred, it doesn't actually show up as a monthly payment. So we use, and different lenders, different Fannie Mae versus Freddie Mac versus FHA loans, they all kind of have a different way of calculating what that monthly payment is. Usually it's like, let's say 1% of your balance. So like
Okay.
VA loan would be like 5% of the balance, but divided by 12.
So what if you pay off your credit cards every month?
If you pay off your credit card, that means you're a great citizen and you're very responsible credit usage person. Unfortunately, we still use whatever is being reported to the credit bureaus. So what you pay off every month is the balance that's being reported. But if you paid off before your credit card ending date is, then what's being reported would be zero. Then what's showing up on your credit report would be zero.
Got it. Does
Yeah.
anybody have any questions for Benson? You have a question for yourself?
Yeah.
Sure.
So a lot of times, like people are always talking about how to get a good credit score. Do you guys have anyone want to chime in?
I'm so old that my credit score is ancient, so
So the the best way, and you know the thing is like I work with a lot of immigrants too, and they're like, oh, I've been here for 3 years, 5 years, and then I have like one credit card or no credit card. I'm like, oh my God, I wish there's like someone out there that they'll tell all the immigrants when you come to the US, get 3 credit cards. Make sure you like get the highest amount as possible. If you can't get 3 credit cards because you have no credit history, start with a secured credit card and then work your way up to 3 credit cards with a significant amount of credit limit. And then once you get there or while you're getting there, only use no more than 30% of each credit card. I like to say 30%, it keeps with the 3 theme. So 3 credit cards, 30%.
does it have to be credit cards? Can it be like an auto loan or what else can we lease or loan on?
RV.
Well, I guess.
Co-signing for people,
Oh gosh, what else is there that other than credit
student
cards?
loan, mortgage.
Well, you can't get a
So
mortgage if you only have one trade line, so it doesn't even
that's
matter.
true. Oh,
Um,
trade line, yeah, that would be a topic too.
yeah, I'm trying to think, but okay. So I kind of want to shift a little bit because I've been asked a lot. Well, actually, before I shift, does anybody have any questions for Benson about just the basics of loans?
So with
So,
that building,
oh, I was just gonna add like credits. Auto loans don't really do much about with your credit score. Like because you have an auto loan and you think you're gonna pay it off and improve your credit score, that's not true. If you're going to get an auto loan so you can get a better credit score, that's also not true. Missing a payment on your auto loan or student loan is going to absolutely destroy your credit score. I've seen, so like, who has a student loan here? Nobody. Okay.
I guess some of my mentees
All right.
have student loans.
We're
That's
all very blessed people here. I never had a student loan, but I've seen people who have student loan, right? So think about it, student loan. You go to school every quarter or semester, you go and apply for that student loan, you draw money out. So each time you do that, it's a new loan. Okay. So imagine 4 years in college and each quarter you get one. That's 16 loans you got. You're a very diligent student. You got 16 loans. That's 16 items on your credit report. You're only required to make one payment. That one payment pays for all 16. If you miss one payment for 30 days, you're 30-day late for 16 payments. Let
wow.
that sink in a little bit. You'll get 16 30-day late on your credit report if you miss one payment for 30 days. If you forget it, you're like, screw it, 90 days, boom, you're done. So, yeah, I've seen the highest I've seen is 9 missed payments on a credit report. Absolutely destroy that credit report. Oof, feel bad for that guy. I hope he's doing well. God bless him. Sorry,
Yes.
Andrew, you had a question.
yeah. So going back to those payments, is it as long as like, let's say for example, me, I have a credit card, right? And then there's like those minimum payments that's due every monthly. Were you referring to those like the minimum payments, or should we pay off like the whole total?
You know what? You can pay off whatever you feel comfortable with,
Mhm.
as long as your balance to your credit limit, the ratio is 30%.
Okay.
So what is your limit?
Because I recently opened a credit card and it's I think like 3,500.
Okay, what's your balance on it?
Right now, I think I'm sitting at 6 to 700.
Okay, that's very healthy.
Okay.
Don't. So a lot of times, like people, and I was a victim of it too. Well, not victim. I made that choice. I was a grown ass adult. I made that choice of doing a balance transfer. They always send you stuff like, oh, balance transfer is 0% for the first 6 months. You only pay 3%. Okay, take a second and think about it. You're paying 3% to transfer balance to a new bank or new credit card for 0%. But you're now maxing out that credit line immediately after you transfer it. Right? They're not going to give you a $10,000 limit for a $3,000 credit card transfer. They're going to give you a $3,000 credit card limit for a $3,000 transfer. So you're maxing out that card immediately. Same thing for any retail store that you go to, right? You go to Express, you buy a bunch of suits. The guy's like, hey, you want to apply for a credit card? You buy like $1,000 worth. What limit are they going to give you? $1,000. And then how much are you putting on your credit card? $1,000. And now you're 100%.
Hmm.
You're 100% maxed out.
Yeah.
So I love credit talk. I don't think there's enough credit talk in this world.
So, okay, so let's kind of pivot a little bit. There's been a lot of talk about the increase of interest rates that's going to affect the housing market.
All right, man. Yeah.
I know we talked about this a little earlier today, but I guess historically what I think a lot of people don't realize is because they haven't been in the industry or around finance long enough to know what we know. But can you share a little light of how the economics work when it comes to higher interest rates and lower interest rates?
So it goes back to the PITI and the DTI, right? Who remembers PITI and DTI?
They're a
So
very quiet bunch.
I
Like,
know.
I do.
All right. Let me recap. PITI is your monthly payment on the mortgage, right? Remember, PI, it's basically the I is determined by the interest. And your P is also actually kind of determined by the interest because you're amortized over 30 years. So that payment will start shifting more towards the interest, less towards the principal. But that payment generally will start going higher as interest rate increase. And then how's that going to affect you? Your debt to income ratio now is you're going to need to make more money to make up for that increase of debt payment. Well, your client may not have received a increase of income for this year yet, but yet interest rates going up. So then now they may not qualify for as much as they thought they had originally qualified for. So in fact, we're going back in our pre-approved client pool and say, hey, who needs an updated pre-approval letter because they might not qualify for the same amount as they would 6 months ago had we maxed them out at that time. And you will start seeing that people having to pay more, but I don't know if it's going to slow down the purchase market. There's still a lot of demand. Maybe, instead of 120 people looking at a house, it might be like 80. Instead of 12 offers, you might get 8 offers. It's still going to be an abundance of buyers out there looking at homes. It's not going to make a dent in this buyer's market at this point. Not yet. Something else has to happen.
Such as?
Such as, let's say if everyone go cuckoo and start going to the market and buy up everything because they think hyperinflation's coming, and well, inflation is here, and if everyone goes to the store and buy up everything, it'll drive up the inflation even more. So then it will cause hyperinflation, and in a hyperinflation world, the feds will really have to put a lot of things in place, maybe even increase the interest rate even higher than what we anticipated. So you might have an issue.
Do you feel like we're kind of in a hyperinflation market right now, though?
Well, hyperinflation, we're talking about 25% inflation. We're at about 6-7% right now.
But last year, home prices increased in a lot of areas at least 20%.
And in a lot of areas, and we're kind of in a different bubble here too. In Southern California, as much as people say, oh yeah, a lot of people are leaving California, a lot of people are still staying in California. A lot of, my generation or even younger are starting to look at homes. So I don't think it's going anywhere at this point. A lot of people are on the sideline. A bunch of VAs are on the sideline waiting for the market to calm down so they can buy a house. And why are VAs on the sideline? Because they can't get into an offer, like your multiple offer situation. You're putting 0% down. No one's going to be like, oh yeah, let's go help a VA. No, let's go help the guy who's putting 40% down and guarantee that the appraisal is not going to affect my sale.
Speaking of appraisals, so I found out recently, is it true that if you're doing a VA or an FHA loan, if you put no appraisal contingency and the appraisal comes back short, the seller needs to honor that appraised value price?
The buyer.
Well, no, the seller needs to honor it, meaning that they can't say, no, the appraisal came back 50K short. We're in escrow for 50K more. So we're going with that 50K more.
In an FHA loan or VA loan, you might have a leeway to fight that. For a conventional loan, typically, let's say if the
That's what I meant for a VA FHA loan.
Yeah, you actually, the seller has to sign an agreement, and I forgot what that form is. I can get back to you guys about it. But for a VA FHA loan, yes, you basically, the seller has to honor what the appraisal value is, and that's another reason why the seller doesn't want to accept an FHA and VA loan. And we try to get out of a FHA loan every time, right? VA loan, I get it. You're putting 0 down. It's your benefit. Let's help you get that deal in. Yeah.
Interesting.
And speaking of that, a lot of times agents like to remove appraisal contingency as a tactic to get into escrow, and which I think it's getting old now. A lot of people are caught onto it. But basically, I mean, in a world where your home inspection is longer than how fast I can get the appraisal back, that may work still.
Can you explain a little bit about that?
Okay, I don't know. That is kind of deep though. Like, are we going into that contracts?
No, let's not. That's too deep for my brain.
That's why I kind of paused a little bit. It's a little deep. We'll get there though, guys. We'll get there.
Does anybody else have any questions for Benson?
For the PITI, we had it was a monthly payment on mortgage. And then for the DTI, what was that again?
Debt to income ratio.
Debt to, okay, got it.
Yeah, how much you're paying versus how much you're making. And how much you're making. Let's say if you are a wage earner, you work for a company, we always take the gross income. Before your 401k, before you pay any taxes, your gross income. So let's say you get paid $30 an hour, we take the $30 an hour. A lot of people are like, I'm self-employed, do you take after tax? What it really means is, do you take after expenses? So you, as a business owner, let's say I own a restaurant, right? Again, I get all the income for selling food, and then I have my expenses, which is the food cost or the rent or paying my waiter, waitress, servers. So it's your income minus all those costs before paying taxes. We can get into that next time. It's going to be pretty deep, and I don't think you need to know about that. So basically, I like to, like, when you guys, I think it's really important to qualify your buyers, asking the right questions up front, so then you're not like you. I was talking to Karen earlier, like spend 80% of the time qualifying the client and work with the 20% that really yield you the 80% of the results.
So, as a lender, what would you recommend for agents to do to give our clients the best possible experience when it comes to, referring them a lender?
Yes, get scripted. I know a lot of times that people are like, "Oh, I don't like scripts," but like, there is a way that you like to convey messages to your client. I would say, heck, write it down, practice it every day until it's natural, until it's genuine coming out of your mouth. Then it's really not scripted after all, right? If it's coming out genuine, it's not scripted. Um, how do you refer the client to a lender, right?
Mhm.
Um, asking questions, I think it's key. Like, hey client, like, what those questions, like, who are you working with, what kind of experience they have. I would like to connect with them, check out their Yelp, check out their everything you can, and ask a bunch of questions. Have you talked to them over the weekend? Have you talked to them at night? Do they even speak, some clients, they have parents that speak Chinese, that you know maybe the client look for someone who don't speak Chinese and to help out, and then the parents are kind of in the dark most of the time. So like you want to ask questions in the sense where you understand the situation, and hey, if they're working with a great lender, that's fine. If you think, hey, I don't think this is the right fit for you, I think we have a better fit on our side, I'd love to have you meet a couple of our lenders, talk to them, understand their process, see what the difference is, and make that decision yourself. Do that upfront for the lenders. Like, think about it for yourself too, right? Do you want the client to shop for a real estate agent when they're opening escrow after they find a house, or like way upfront, like before? So then you're not wasting time. Same thing goes for the lender, right? I don't want them to waste other lenders' time. I don't want them to waste our time as well, because we want to work, give the time to the right people.
I have a question, Benson.
Hi, Brian.
Is there anything in like the conventional scripts for getting pre-approved that you would want to add to that you don't think are in most conventional scripts for us?
Karen, do you? Oh, you know what, Brian? Why don't you tell me what the conventional scripts are that you use?
Okay. Let's say you're a buyer interested in a place. I would ask, first of all, are you pre-approved or pre-qualified? Have you looked into that?
Mhm.
Oh,
Um,
now, yeah, I have.
Okay, but have you talked to a lender yet, Karen?
Yeah, I've talked to a couple.
Okay. What did they say? Did you?
They just asked me for they asked me for my tax returns, my W-2s, my bank statements. But I haven't really decided who I really wanted to go with yet. So I don't necessarily want them to pull my credit because they said that once I submit these documents, they have to pull my credit, and I don't want my credit score to drop.
Well, no, your credit score won't necessarily drop if they pull your credit. They're just doing a credit check on you. I'm sure the lenders can tell you more about that. But if you're serious about buying a home, you're going to have to do this sooner or later. So you might as well do it sooner, right?
I guess, but I still, but I've been told that my credit will drop once they do an inquiry on my credit. So I
Yeah,
mean,
but
it's like if I go to 3 different lenders and they all give me a pre-approval letter, then isn't my credit going to drop like, 10 points?
so I'm not too sure on this, Benson, but will your credit score drop if you get 3 credit checks on yourself?
So, so each time you get a credit check, it's a credit inquiry, right? And as a credit reporting company, they know that you're shopping for mortgage. So while you're shopping for mortgage, you're running your credit with other lenders. They're going to be able to see that, oh, this person is actually looking to shopping for a rate. Maybe they're going to a different mortgage. So it all actually counts as one inquiry. But let's say if you go to a mortgage company and you go to a car company and then you go to Tiffany, you go to Express, that's multiple different types of inquiries, and that will eventually drop your credit score. And Karen had mentioned that she's afraid of dropping 10 points. So it's like, well, if you're at 800 credit score and now you're at 790, nothing will really change in terms of your qualification or your interest rate.
Okay, well, what if I'm at 700 and it
If
drops?
you're at 700, you should really talk to Benson and have him pull your credit score and see what you can do to improve your credit score to 740 or 760, which gets you the best interest rate and mortgage insurance rates.
Can I safely tell a client they could go to 50 different lenders and get 50 different credit checks and only counts as one credit check?
I would say like 4 or 5. I haven't personally done 50 yet, or seen anyone who's done 50, but I mean, I don't see why not.
Okay, so
If
4 or
if
5.
that
All right.
theory holds up, yeah.
Okay.
That's just a big waste of your time, though.
Okay, that's good
Or
knowledge to have. Thank you.
yeah, or you don't really need to waste your time and just go straight to Benson. It's like a one-stop shop.
So, okay, my last question. What's the difference between a mortgage broker and a lender?
Her question is, what's the difference between a mortgage broker and a bank? I think, right?
Well, yeah.
Or mortgage. Were you saying something else? Mortgage banker? I didn't hear
Oh,
you.
I said direct lender.
Oh, direct lender, mortgage broker, and a direct lender. So, mortgage broker and direct lender. So think about direct lenders, maybe like Chase or Wells Fargo at a bank, where you know they they're great. They're a bank, right? FDIC, blah blah blah. Insure your money up to $500,000. But like
50, but okay.
but like they're really good at doing bank stuff, going to work 9 to 5, um, maybe occasionally have to open and close on the weekend. They open checking savings. They're really great at auto loans, some student loans too. But when it comes to mortgage, they have their own bank products. They may sell loans to Fanny and Freddie too, but they only have the Wells Fargo or Chase product that they have for anything else. When it comes to a mortgage broker like us, absolutely we're more aggressive because we don't just work 9 to 5. In fact, I've worked as late as 9, 10 o'clock, not what I want to do every night, but if necessary, we stay up to submit a client's file, right? If your client's like, oh my God, they just got denied and they need a fund in 2 weeks, we hop on and get it done. Um, we're more, I would say, like mortgage brokers are usually more, they've seen more, right? In a case where we do loans, not just conventional loan, not just jumbo loan. We work with other wholesale lenders. We work with other lenders with their products. So we have multiple products for a lot of different types of clientele. And did I mention we don't just work 9 to 5?
Yeah.
Also, when you work with us, again, we have 22 people. KWE is like a big account for us, so you guys are getting preferential treatment. You're assigned. You're going to eventually be assigned to like a loan partner of mine, and they're all really, really great. Be able to answer any questions for you guys.
What's the name of your company, Benson?
It's Nestmade Mortgage. NESTMADE, like a bird's nest. And if you Google us, you'll be able to find us on Yelp and our webpage as well.
Okay. Thank you, Benson.
Does anybody else have any other questions for Benson? I didn't realize we're already almost at like the hour mark.
I know. I like, my voice is like.
You want to send you some tequila?
That will help.
Yeah. Does anybody else have any questions for Benson?
If not, this is also recorded, so you guys can go back and listen to it if you can't fall asleep tonight.
Thank you so much, Benson. I really appreciate you doing this call for us today, and for my mentees. I'm sure they have a lot of takeaways just from us giving them like just the basic 101s of mortgage.
Yeah, it's an honor to do this. If you guys have any questions, there's no stupid question. The stupidest question I've heard is not being asked.
Do you want to?